Good evening and welcome to First Super's webinar, Boost Your Super Before Retirement. My name's Louise and I will be joined shortly by a financial advice team who will be talking you through simple and effective ways to grow your super balance and make the most of the tax benefits available to you as you start or continue in your retirement planning journey. Tonight's webinar will run for about 45 minutes and we will have time for questions at the end. This is being recorded and we will send this to you next week. Let me begin by acknowledging the traditional custodians on the land on which we meet and by paying my respects to the elders past, present and emerging. I also extend that respect to Aboriginal and Torres Strait Islander peoples attending this webinar. Firstly, I do need to start off with a bit of housekeeping. We encourage you to ask questions using the Q&A button at the bottom of your Zoom screen. Questions are anonymous and we will do our very best to answer all of them. And a little bit about First Super. So we are an industry super fund with more than 79,000 members and 5.7 billion funds in management. We have a dedicated member services team and we pride ourselves on the level of service we can offer our members across the country. We are a fund that you can stay with for life. So you can take us through your accumulation phase when you are working, into your transition to retirement phase, and finally by opening a retirement income account to receive an income even when you've stopped working. Now onto the disclaimers, because it wouldn't be a superannuation presentation without some disclaimers. This presentation has been prepared by First Super and may not be used or reproduced without the prior written consent of the trustee. The information in this presentation is accurate as of today's date, Thursday, 9 July 2026. First Super has engaged industry fund services to provide financial advice to our members. All our financial advisors are authorised representatives of IFS. And further information regarding the cost of advice is set out in our financial services guide. The information in this presentation tonight explains concepts, strategies, and ideas in a general way. If you feel it could be applicable to your personal situation, we recommend you obtain financial advice before taking any action. And finally, on to the fun part. Let's meet the team. Joining us tonight is Andrew Jewell, our Executive Manager of Financial Advice and Education, and financial advisors Jason Bruce and Daniela Beltianu. And now I would like to welcome Andrew. Andy, over to you.
Thank you very much, Louise. And, welcome everyone that's joined us here tonight. I do appreciate you giving your time to us for this webinar. As Louise mentioned, this webinar is giving an overview of what members may want to do before they do retire. In other words, how do I boost my super to make sure I've got sufficient funds so that when I do retire, I've got enough income and enjoy my retirement years. So admittedly, when we talk about boosting the super and when we sit down with our members and discuss their retirement plans, what we kind of like do is we start off with is trying to understand about what it is they want to do in their retirement years. Consequently, that would tell whether the person's on track or not. And if they're not, what are their options to build up their super before they do retire? Or maybe they just want to have more funds in super to ensure that they do enjoy those retirement years from that perspective. So that's what we'll be talking about tonight. So what we're going to do then is actually start off with talking about something called the ASFA retirement standards. So I'm going to hand over to Daniela. And Daniela, can you just explain what ASFA retirement standards is all about?
Yeah, sure, Andy. The terminology of modest or comfortable lifestyle, as shown in this specific slide, it might mean different things to different people. And a lot of our members actually fall somewhere in between these two specified lifestyle as far as their retirement needs go. But overall, a modest retirement encapsulates people who are more budget conscious and are living a simpler life. Just as the picture shows, they might have a caravan, so they potentially do some local small trips. They are more housebound, so their home is their world. They do a bit of gardening, a bit of fishing. They're more concentrated on families coming and visiting them. They are potentially doing some babysitting and looking after their grandkids. They could potentially have a basic healthcare insurance, so nothing nothing luxurious, not too many bells and whistles. They might have an older car and are not looking at upgrading, so they're happy with what they've got already. So overall, they live a decent lifestyle without having a lot of the luxuries, as I've mentioned. Comfortable lifestyle on the other side, on the other hand, is a more active lifestyle. People go out more, they're more socially active, they travel, potentially even planning overseas trips. They're going and trying new restaurants, they're enjoying additional leisure activities, they are potentially paying for some memberships at their local clubs. They might look at buying a new car or allocating additional funds for some home renovations. So they can go on spontaneous weekends and meet with their friends outside and spend more money. So overall, these retirees can enjoy more, as I said, bells and whistles without, being too worried about where they will fund the expenses from.
Okay, fantastic. Thank you very much for that description. So what we're going to do now is, and why not? It's a webinar. Let's get some participation from those that are attending. Based on that description of a modest and a comfortable lifestyle, what do people think they are trying to achieve when they do retire? So we're going to put up a little bit of a poll, and yeah, we just want to get your opinions on which one is it that you're trying to achieve. Okay, so we got some people responding. We just give it a couple more seconds. Okay, so thank you very much for those that did respond. And what's come out of that is that most people actually are intending to travel. That doesn't mean they don't want to spend time with their family or anything of that nature, but it's a big priority for them. So the majority did come up with that option, so that more comfortable lifestyle they potentially are looking for. But there was a good number of people that are saying that family is very important to them, and that is going to be central to their retirement years for whatever reasons, and they all do differ. Like Daniela said, people don't fit into these categories perfectly. They may want to do a little bit of mixture, but there is a main element that they're trying to achieve in their retirement. So when we talk about retirement to our members, this is kind of like where we start, because this then starts to enable us to determine how much the member may need to start to accumulate, or do they have are they on track for those types of lifestyles. So here, underneath those retirement standards, there's some income that the people are potentially going to need for, depending upon what lifestyle they're wanting to achieve and how much funds they want. So maybe Daniela, again, if I can just ask you just to explain this slide.
Yeah, definitely. So just as the poll showed, once the member kind of decides what type of lifestyle they want to live, it's important for them to understand the budget that they need to work going forward in their retirement. Now, ESFA did their research and they come with this particular number. So for somebody who would ideally want to live a simpler, more modest lifestyle, they're saying that a single person would need just over $36,000 per year to fund that lifestyle, and a couple would need about $42,500 per year. For a comfortable lifestyle, as expected, you'd need a little bit more money to fund those extra luxuries and extra trips and whatnot. So ESFA came up that a single person would need close to $56,000 per year to live or to enjoy that comfortable lifestyle, and a couple would need just over $78,500 per year. Now, keep in mind that ESFA is utilizing some assumptions in their calculations. So they are assuming that you are owning your own home, so there is no mortgage or any rent to be paid. Their assumption is also that you've reached your pension age, so age 67, and that you are entitled for an age pension. So part of that income is already expected to come from the age pension payments. When it comes to funding those lifestyle, again, ESFA said that a single would need $110,000 in assets to be able to fund that lifestyle for their life expectancy, assuming they do get an age pension payment as well. And a couple to fund a modest lifestyle would require a little bit more, $120,000. To fund a more comfortable lifestyle, as you can see, the assets required are much higher. So a single would need $630,000 in assets. And that's obviously including your superannuation or any kind of cash and bank savings that you might have. And a couple would need $730,000 to fund a comfortable lifestyle, with the assumption that some or part age pension would come into play as well.
And that last point is very important. And again, it highlights the differential that you raise and the assumptions that are made. And that is, these assumptions are made that the person is of age pension age, which is 67 at this moment in time. And to that last point you made, the comfortable lifestyle, these people have accumulated quite a bit of financial assets, maybe just superannuation, and consequently they're receiving a partial age pension. Whereas those that are acquiring a modest lifestyle, then maybe they haven't accumulated so much for whatever the different reasons being, but consequently they're getting the full age pension. So they just need to top up that income with a little bit more money, and hence why there's such a significant difference in the amount of funds. So to put this into perspective, Jason, you recently met with a member and you kind of were having this type of conversation with them. Can you just share what the outcome of that conversation was?
Yeah, sure. It was a couple who were getting close to retirement. So the member was approaching 67 at the end of the year. His wife was a few years younger, admittedly. But their main concern was that they wanted to retire, but they were really worried that they couldn't. And a big part of that was they were renting. And you hear a lot around you need $1 million to retire, you need this to live off, and it can be very confusing for some members, and they didn't really know what they needed. So we used this as for modeling the modest lifestyle, the comfortable lifestyle to get an understanding of what they wanted, and they really wanted to match their current lifestyle, what they were doing now. And it really was more aligned with that modest lifestyle. He was working and bringing home around about $2,000 a fortnight. So it sort of really matched that modest lifestyle. But big sort of concerns around how long their money's going to last and can he actually retire. Despite them not really having any other assets, they didn't own their own home, they didn't have a lot of savings. He did really well to build up his super account, and he had around 300,000 in there. So when we went through this modeling, we discussed the type of lifestyle that they could live. Certainly, we then looked at the modest lifestyle, and they could actually meet that and a little bit more. So sort of somewhere in between that modest and comfortable lifestyle. Maybe we can call it sort of modest plus or something like that. And that sort of really did alleviate a lot of concerns that they had around retirement. He actually just retired last week, and we set him up with an income stream. So they're now entering into that phase where they can do a little bit, still going to be primarily home focused, but have a little bit of extra income there, and really enjoy their retirement knowing that they've got enough funds to do so, as opposed to entering into it with, a lot of anxiety around, can I afford to do this? Can I afford to do that? So it was a real nice story that they're able to happily enter into retirement rather than enter in with a lot of anxiety.
Excellent. And then to your point, two main points there is that they were able to ascertain that they can retire and they can enjoy the lifestyle that they're wanting to achieve. They've got sufficient funds around there. And the other point that you kind of very much highlighted, and what Daniela did highlight in her part of the presentation as well, what we're seeing on the screen is assuming the person is a homeowner, but ASFA also has the required income if someone is a single or they're a couple and they're renting as well. So that's available on our website. So we'd like to highlight that difference as well. So this is great. I mean, so we've now got an idea about the income, and maybe we just go back and just elaborate a little bit more. And maybe if Danielle, I can just get you to just explain what we highlighted before, or what I mentioned was how much role the age pension plays in these income requirements. So if you wouldn't mind just talking through this slide, maybe just using the couple as an example. The same principle applies for a single person.
Yeah, definitely. So this table shows pretty well, I guess, that the importance of the age pension for somebody who wants to achieve a modest lifestyle or comfortable lifestyle. So looking at the modest column, the green one, it just shows that for a single person who wants to achieve that $36,500 per year, the age pension would already supply that $31,000 per year. So they only literally need to top up with about $4,500 from their assets such as superannuation. For a couple wanting to live on that modest income, which again, ASFA established that it's about $52,500. The age pension, assuming they're eligible for the full age pension, would be close to $47,000 per year. So again, they only need to top up with about $5,000 from their assets. And that's what it shows, that you don't need huge amounts in your superannuation savings to be able to achieve that modest income, with the assumption that the age pension will be your biggest future income contributor. ASFA also shows us that even if you are a renter, obviously the assumption is that with you paying the rent, you need a bit more money to bring you to that modest income. So they are saying that a single person would need about $51,000 per year, which means you need a little bit more assets that would, including your age pension entitlements, would bring you to that required income. For a couple, again, renters, the expectation is that they would need about $69,000. With your age pension for a couple being $47,000, we now see that you need a bit more, so about $13,000 that would need to come per year from your assets. For a comfortable lifestyle, the gap is a little bit bigger as well. So a single person needing close to $56,000, and with the assumption that they are eligible for the full age pension of $31,000, you can see here that additional income that they would need to kind of self-fund is larger. And it goes to a little bit more still for couples. So for a couple to live that comfortable lifestyle, requiring $78,500. If the age pension provides only $47,000, again, there is a bigger chunk that they would need to self-fund and to provide from their assets. So the idea is, if you want to live that comfortable lifestyle, you need to have a bit more assets saved up to cover that difference between that age pension and what you want to achieve going forward.
All right, lovely. Thank you very much. I appreciate that. So, okay, we've explained so far that when you're thinking about retiring, you need to think about what kind of lifestyle it is that you want to achieve and enjoy, and consequently, potentially, what is it that your income needs are going to be? Again, what we've highlighted here is that no one fits perfectly to these dollar amounts by any means, but they actually start to provide the expectations that if you're retiring, you're potentially going to need something between 52,000 and 78,000, and these are averages. So some people may want a little bit more, some people may want a little bit less. And the reality is that we've met with members who can enjoy a comfortable lifestyle, and they may only need about $60,000 per annum. What this is, again, just highlighting is that this is just giving you the bookends of what you should be thinking about the income, but your own personal circumstances, your own budget far better than what we would ever do. That would actually determine how much income you need. But this is a good benchmark to start the thinking with. So, okay, we've kind of thought about lifestyle, we've thought about income. How do I know if I'm on track? How do I know I'm going to accumulate this amount of superannuation, if that's my sole asset, and consequently, how do I know that's going to give me the income that I need? So let's go towards a case study that we've prepared here for you. And Jason, if I can get you just to talk through this case study and then consequently what the projection is actually showing.
Yeah, sure. So this really sort of goes back a little bit to my story from earlier as well, in terms of providing a little bit of comfort to members to show them where they're at and whether they're able to retire. So our retirement health check is a complimentary service to all members. Takes about 30 minutes, and it gives them a little bit of a projection around can they retire, can they meet that modest, comfortable lifestyle, or somewhat in between, and their sources of income as well. So just in terms of case study, so I'll work you through just some a potential scenario, which is reasonably common that we'd see. We've got Barry and Debbie, who are both 59. Barry's worked full time for 40 years, so he's thinking he'd like to retire in the next 5 years. Debbie's been working part time for the past 7 years. 4 children, so they've done very well to manage through that, and they've paid off their family home. They're considering that they might want to downsize out of their family home, but not sure whether that's appropriate for them, and whether they're going to do that now or in the future. We can see financially, Barry's super account, he's been working full time for 40 years, so he's accumulated a nice 250,000. Debbie's still trying to bring hers up, so 25,000. Barry's earning that higher salary at 80,000 with Debbie's part-time salary at 25,000. And they're not doing any additional contributions or any real savings at this point. So again, they're looking at that modest income. We've had a chat to Barry and Debbie. They sort of resonate with that. They like being around home, maybe a little bit of travel here and there, but they want to retire in the next 5 years. So they've come to us and wanted to see how their super is tracking. So the outcome of that, we put in these figures and all of the details that Barry and Debbie has provided, and it gives us a nice, neat little graph, which will pop up in a second. So I'll just sort of run you through what we're looking at here. So we can see at the start on the left-hand side of the graph, it's got Barry and Debbie at 59, so it's got their ages down the bottom. And they're meeting that level of expenses through their solely their income. Okay, so through their wages, the orange line at the top indicates what their expenditure is. Okay, so their expenditure is a little bit higher while they're working. They're still paying tax and meeting their living costs there. And then it drops down when they retire at around about age 65. And that's that modest lifestyle. So the orange is reflecting the modest lifestyle at that point in time. Now, with them retiring at 65, it means that they're not going to get any age pension initially. Okay, so they're going to be what we call self-funded retirees, because for everyone going forward, age pension age is 67. So they start collecting a little bit of age pension at around about 67, or really they're getting what looks to be pretty much that full age pension, and their super's just topping them up. Okay, and we can see here the combined amount from the super and the age pension is providing them really more than what they need. It's a little bit over that orange line, so it's a little bit surplus to their needs, which is a good problem to have. It means that they can spend and enjoy their lifestyle, especially through these early years of retirement. In the background, there's it looks like a blue pool of water as well, and that just represents really their super balance. Okay, so we can see while they're working, that pool of water does go up. It takes a little bit of a hit over the first couple of years in retirement where they're primarily self-funded. But then because the age pension is providing most, if not almost all of their living expenses, their super balance isn't really dropping too much over the next 20 to 25 years representing in this graph, to a point where toward the end of this graph in their late 90s, they've still got a little bit of money left over. Okay, so this could be a really important one for Barry and Debbie to look at and say, right, well, we're certainly on track. We're perhaps looking better than what we might have thought. And that can provide some more ideas that, well, perhaps we could get a little bit more than what a modest lifestyle provides. Perhaps we could retire even a little bit earlier, and have that self-funded period for a little bit longer, or even transition to retirement where they might be working, part-time or something else like that over the next few years. So again, it is just a projection to give a little bit of an idea of where you're at, but Certainly, if you're sort of thinking you're a little bit anxious around retirement, what that looks like, do I have enough? Which is the old question that probably 90% of our members ask when they come in to see us. This is a really good stepping point or starting point to ease you into the advice process and just to see where you're at, whether you're on track, or if you're not, then we can talk about some things that we can do to bridge the gap to get you closer to where you want to be.
Thank you very much. And to that very last point, if you're not on track, what are your options are? Let's move into that area and let's start to have a look at some of the contributions that members can actually make in that regards. So while you're still working and as you're into your final year or years of working and you're certainly looking at retiring, what are the options to you that you can boost your super? So basically it comes down to contributions. There's two types of contributions you can make into super, and it's all about tax is the essence of it all. So the first one is what's called before tax, or what is technically known as concessional contributions. And all it simply means is when the contribution goes into your super fund, it gets taxed at 15%. So when your employer makes those superannuation guarantee contributions, they are taxed at 15%. And some people may be familiar with the strategy of salary sacrifice. So consequently, you redirect some of your wages into your super fund before the income tax is applied. And the idea of that is that you're reducing the amount of tax that's paid on that amount of money. So it certainly suits members that are in that 32% tax income brackets. So they're going to have to be on an income of more than 45,000 for this to really work for them. The other option is that a member can actually make a lump sum contribution and claim it as a tax deduction and consequently generate a tax refund. So they make a lump sum just before the end of the financial year, and when they do their tax return, they state on there that they've made this contribution and they claim it as a tax deduction. Those three contributions cannot exceed $32,500. So it's the three, it's the employer, it's the salary sacrifice if you're making them, and or the additional contribution that you claim as a tax deduction. Those three have a cap of 32,500. There is an exemption, and we go into that in a moment. The other type of contribution is then called after tax, or it's technically known as non-concessional contribution. And that contribution goes into your super fund and it is not taxed, or that 15% tax is not applied to it. So again, there's something called the government co-contribution, which says that if you contribute some money into your super fund, the government will match that to 50 cents. But there's some limits on it. So they will only go up to $500 is the government co-contribution. So as an example, if you put $1,000 in, the government will meet that 50 cents in every dollar you put in, and hence that's where they get the $500 in. But that's the maximum that they go to. That certainly suits members that are on a lower salary, and potentially if they're below 49,000 per annum, they're the ones that benefit from this the most in that respect. But also we have members that's come into money. Maybe it's through inheritance, maybe they sold an investment property, whatever the case may be. They may just have some substantial funds that they want to contribute into their super fund. They can do that as a lump sum, and they can contribute up to $130,000 per annum as well. In some circumstances, you can actually contribute more, and it's called the bring forward rule. And what it simply means is you're putting in up to 3 years worth of this cap of 130. So as an example, 390,000. It just simply means you cannot put any more money in as a non-concessional contribution for the subsequent 2 years. So you can do this type of contribution all the way up to age 75. So again, where do people use this is if they've come into the inheritance, as I mentioned before, or they've sold an investment property and they want to invest the net proceeds to that. There is what a third option called a downsizer contribution, and again, we will explain that in a moment. But if you want to boost your super before you retire because you're not on track, or you just want to put extra money in there to ensure that the funds are there available to you, so you enjoy their life, these are the two options: before tax or after tax. The before tax, there's a contribution tax applied of 15% to it, and if you don't want any tax applied to your funds because they're of a substantial amount, then there's what we call the after tax, the non-concessional contribution in that respect. So for some members, though, they don't have this cash flow that they can make salary sacrifice contributions, or they're not going to receive a large lump sum through an inheritance or something of that nature. So what are the options available to them that they can boost their super before they do retire? Well, there's something called the transition to retirement strategy. And Daniela, if I can get you to explain what the TTR strategy is all about.
Is it okay if Jason covers that?
Oh, my apologies. Yes, yes. Jason, if I can get you to explain that.
Yeah, no. So transition to retirement strategies or a transition to retirement account is available to members when they meet what they call your preservation age. And going forward for everyone, that's going to be age 60. All right, so we'll need to be age 60 to have access to this strategy. If you're under that age, unfortunately, we'll have to wait a little bit. What the transition to retirement strategy does, it provides you access to basically 10% of your superannuation balance each financial year, tax-free. And you can use this transition to retirement for a range of purposes. You can use it potentially to work less, which we have on the right-hand side there. So I'm wanting to work fewer hours, but I'm not able to afford it. I can take a regular payment from my transition to retirement account just to sort of meet that income gap. Okay. But the other approach to it is around about saving more and building your super, and that's really what Andy's referring to. And that's where we can really build your super in these last or leading years towards retirement. What we effectively will do is say, okay, I'm in a situation where I'd love to salary sacrifice. It's going to save me a lot of tax, but I can't afford to do it. So the transition to retirement will create a second stream of income for you. And because that's tax-free, whatever it is that you're drawing out, now I've got this additional pool of funds that's coming into my bank account on a fortnightly or monthly basis. Okay, now I've got the extra income that's allowing me to salary sacrifice. Because I'm paying less tax, or it's only taxed at 15% if I'm on a higher income, that's allowing me to grow my super by putting more contributions in while taking home a regular tax-free income from my super. So it is a little bit confusing in practice. That's where we can sort of come in and provide a little bit guidance around how much to do, how we want to deploy it. But effectively, the strategy is a tax reduction and super boosting strategy where we're replacing our higher taxed income with tax-free income from our super, directing the surplus then into our super account, which is just building it up a little bit more. So it's certainly a good strategy that if you're over your preservation age, if you're over 60 and you're not doing any salary sacrifice, it's at least worthwhile having a think and a chat about it to see whether it might be suitable for you going forward as you lead into retirement.
Okay, thank you very much. Now I will go to Daniela. And Daniela, you were talking to a member around this very strategy. Would you mind just sharing that conversation that you had with the member and how you assisted them?
Yeah, definitely. So the example that I have actually incorporates the combination of the two strategies that TTR can be used for. So last month I saw a member. He was he's 64 and currently working full time and wanted to reduce his working hours from 5 days down to 3 days starting July. So we've established that the difference in income by reducing his working hours was of $24,000. He had a balance of about $370,000, so a reasonably healthy superannuation balance. And based on the fact that he was able to access 10%, what we did was last financial year, we've accessed some of the funds and recontributed it back into his super as a tax-deductible contribution, which allowed him to receive $5,000 in tax refunds. And as of July, we are setting him up with that $24,000 additional income that he's requiring per year, paid fortnightly, which will allow him to reduce those working hours down to 3 days to kind of establish him and see if he enjoys this transition to retirement before he decides to completely stop working at age 67. What we also did and I think it's an important kind of peace of mind for him, was we ran the projections for his retirement and we showed him that he could actually continue maintaining this same level of life expenses way into his retirement, and he would have enough assets to last him his life expectancy. So he was on track with, maintaining what he's used to all the way into his retirement as well.
All right, great story. All right, thank you very much for sharing. We do have a question. I just want to acknowledge it, and I'll come back to that question in a moment. But what I want to go to now is when I was talking before about the two types of contributions you can make. When I was saying the before tax, and they had a cap of 32,500 for this financial year, I said there was an exception, and it's called the carry forward rule. So maybe Danielle, if I can just stay with you and get you to explain what is the carry forward rule and how does it work?
Yeah, definitely. So, as you said, there are rules and then there are exceptions to rules, and carry forward is one of those exceptions. So, as you mentioned before, the concessional contribution or the before tax contributions are kept at the moment at $32,500 per year. Now, this rule was introduced in the 2018-2019 financial year, and what it means is that members can now bring or carry forward 5 previous years of unutilized caps. To make a little bit more sense, we have an example here showing that Sylvia, who has a balance of $350,000 as of June 2026, and that's an important element of this strategy, is your balance needs to be below that $500,000 at the end of the June of a particular financial year. So what she did, her employer done the contributions for the previous 5 years, and you can see in that row in the 2021-2022 financial year, the employer contributions were of $6,500. In that particular year, the contribution cap was of $27,500. By subtracting those two amounts, we've established that her unutilized concessional cap was of $21,000 for that particular year. Same type of calculations can be done for the following 4 years. And we've established that over the 5 previous financial years, she has an amount of $98,500 of that carry forward that she could potentially utilize. Now, it doesn't mean that you necessarily need to utilize the whole amount in one go. It obviously, it depends on what your income is, or potentially if you sold an investment property and you have this capital gains tax that you want to reduce, that would be a good time to do it. What we're trying to say is don't go too crazy over contributing as far as the concessional contribution goes, because it might work against you because you're still paying that 15% tax on contributions going into your super. So you just want to try to reduce your marginal tax rate as much as you can. So again, it's a great strategy to build your superannuation and reduce your tax. And in our experience, we've been doing a lot of these carry forward contributions with our members over potentially 3, 4, 5 years before they retire, just because we are able to reduce their taxable income over this continuous time frame. A good source of information is your MyGov. If you go and log into your MyGov, you will be able to see what your carry forward amount is at any particular day or year. But again, an important thing to remember is your balance, your superannuation balance needs to be below that $500,000 to be able to utilize this rule going forward.
Yeah, and that's a very important point. And it's the 500,000. It's got to be below 500,000 at the beginning of the financial year. If it goes above during the financial year, that is not a problem, as long as it was below at the beginning. So on the 1st of July, that balance was below. And to your point, Daniela, as well, if people are curious about, how much have I got as a carry forward rule, you can go to MyGov ATO Super, and there's some drop down menus information, and you just click on carry forward, and it will then show you how much is available to you. So Jason, I mean, again, you just spoke with a member just recently where you utilized this particular strategy in conjunction with the TTR strategy. Can you just share a little bit more around that?
Yeah, it was a bit all-encompassing with all these strategies coming together. Tends to be at the end of the financial year where these strategies can really come into play. So we had a member who had about $350,000 in his super. He was 62. He was looking to build towards retirement in the next few years. He did have a small mortgage, so he didn't have the cash flow to make those further contributions, didn't have any savings. The other thing that was probably a little bit troublesome with this member as well, his employer was struggling with cash flow. So the contributions coming into his first super account weren't very regular and oftentimes weren't happening. So we had to be very cautious around doing salary sacrifice because we didn't want to necessarily do that. And then the contributions weren't coming in. So that tax deductible contribution and that transition to retirement account was what we utilized. And what we did was with the $350,000 balance that he had in his super account, we made a lump sum contribution of approximately $35,000. So we took that 10%, put it back to his super account. So we were able to claim that as a tax deduction, which meant that yes, 15% tax did go out on that contribution, but he's able to claim that as a tax deduction. So the overall net impact was that the member saved around about $5,600. Okay, and what we said to him was when you do your tax return and you get that considerable tax refund, we can again put that back into super in addition to that ongoing transition to retirement payment, utilize some of the carry forward. We weren't utilizing the whole amount that he did have, but we were doing as much as we could. And it was really sort of a good strategy to boost his super, minimize his tax, and do it in a way that suited him because those regular salary sacrifice contributions probably carried a little bit more risk than I was necessarily comfortable with recommending given the nature of the contributions coming in.
All right. Thank you very much. Very good. And I highlighted before there is a third type of contribution, and that's called the downsizer contribution. And Daniela, again, if I could just ask you to explain, what is this about?
Yeah, so this is an additional contribution of 300,000 or up to 300,000 that a person can make. And these contributions would come from the proceeds of the sale of their home. There are some eligibility points that a person needs to comply with to be able to make this contribution. So you have to be age 55 or over. You have to have owned the property more than 10 years before the sale. And there are a particular time frame in which you have to do the contribution into super. So it's 90 days from the day of the contract was signed. And keep in mind that this $300,000 contribution is per person. So if you are part of a couple, each part of the couple can contribute this $300,000. So all of a sudden, a couple can contribute $600,000 into their super. And these contributions are also not part of that after-tax contribution. So for the argument's sake, if you have already $350,000 in your bank account that you're contributed as part of the after-tax, then you can then go and put another up to $600,000 as a couple. So it's a considerable amount that a couple or a single person can contribute in one go without exceeding the caps as such.
Yeah. And just to clarify, when we say $600,000 for a couple, that's 300,000 each. You can't go above 300,000. And Jason, again, you were dealing with a member where, again, you gave them some advice very much around this topic.
Yeah, it provides a lot of flexibility for members who are downsizing. My one was a little bit of a unique situation where the member was traveling quite a bit to look after and help out with some grandkids. As much as they liked their lifestyle in their home, they decided to move to get closer to the kids and grandkids. They were 71 and had retired. So he had around about 500,000 in his super account. But the problem that they had was the new property was going to be settling and they needed to basically pay for that property while their other one was still on the market. So it provided them some issues in terms of what do we do in terms of grabbing the money and paying for this new house. Financing is obviously difficult when they're of that age and can be quite costly. So what we did for them was we took 400,000 out of his super account with a little bit of savings that he had, and that enabled him to purchase the new property. Once the settlement occurred for his existing property, he was able to use the downsizer of 300 plus 100,000 from his ordinary after-tax cap and basically replenish the proceeds of his super. Okay, so there's a little bit of timing risk and some issues that are associated with that, but the outcome for him was positive that he was able to, in a very stress-free way, get the money out of super, purchase the new home, replenish that as soon as the funds came in, and now he's in his new place. His super is basically been fully replaced, so there's been no difference to him there, and he's now just continuing to receive his income on a fortnightly basis as he was before in the new home.
Very good. Okay, excellent. So in essence, that's what we've presented tonight. So again, just to recap, what we've suggested is that if you're thinking about retirement, start with what kind of lifestyle it is that you're wanting to enjoy in your retirement years. It's not a static retirement plan in that, we describe that when you do retire, there's going to be initially your active years, and that could be the first 15, 20 years. That's when you do everything that you want to do. But the reality is that health, physical capability deteriorates and you will slow down, and consequently you will be more housebound. Consequently, your living expenses will reduce. That's what all the research has shown. And yes, very much towards our later years, there's that aged care factor. So whether you want funds in which to pay for those services, but the main point being is that, again, when we get to that aged care status of our lives, income requirements reduce as well. So the point being is that when you're thinking about your retirement, think about what lifestyle it is. Yes, there's the retirement standards that give you an indication about potentially what income you may need, depending upon the lifestyle you want. Certainly do a retirement health check. We have a calculator on our website called the Retirement Calculator as well. You can do it yourself, and that will show you potentially that by the time that you retire and you're wanting a certain amount of income, how long is that going to last for? And if you just want to then boost your super before you do retire, there's options for you. There's 2 contribution strategies. There's the transition to retirement strategy if you don't have the cash flow, and there's the carry forward rule if you have some additional funds or you want to utilize it with the transition to retirement strategy to boost your super and minimize your income tax around it. And yes, somewhere for some people, and we've seen it more and more, people are downsizing, and consequently that gives them the opportunity to contribute more funds into their super. We do have some quick questions, so we'll just go back through and just start seeing if we could go back to the downsizer contribution slide. Danielle, there was just one question. It says, is the downsizer contribution tax-free?
Yeah, because your house, the sale of it's not considered an asset for tax purposes. So whatever contributions come from the sale of your own property, there are no additional tax that you need to pay. And it's considered part of the after-tax contribution. So there are no superannuation taxes involved either.
Okay, great. All right, and if we can just go back a little bit further to the carry forward case study slide. The question here, Daniela, was that you mentioned people should not go too crazy with the carry forward rule and the 15% impact. Can you just clarify what you actually meant by that? Maybe using the example of the 98,000 that's accrued in this case.
It all goes back to your marginal tax rate. So there are particular brackets. So the first $18,000 or $19,000 of your income is tax-free. Then the next step up till about $45,000 this financial year will only be taxed at 15% on your income. So all I'm trying to say, if your income is 45,000 or below, potentially there is no additional benefit for you to do this additional tax deductible contribution because you'll already be taxed 15% when your money are allocated to your super. If your income is higher than $45,000, and then yes, there are some additional benefits to reduce that marginal tax rate that you're currently paying. So just for a quick calculation, if your income is, let's say, $100,000, by doing, if you're doing any salary sacrificing or any other tax deductible contribution, so let's say we can do, in this example, Sylvia had $98,000. Let's say we're utilizing $40,000 out of this cap. So by doing this 40,000 tax deductible contribution, it will mean that instead of 100,000, Sylvia will now be liable to pay tax on the difference, so on $60,000, which will considerably reduce her taxable income, and thus she'll receive a big chunk of tax refunds when she does her tax next financial year.
And then just elaborate a little bit more on that point. It's no use Sylvia using the whole 98,000 if she only needs to use 40,000 of it. If she used anything more than that, all she's going to end up doing is paying 15% tax on a contribution that wasn't really required to minimize her income tax. So again, that's a part of what you were saying, as in don't go too crazy with this. Just because you see 98,000 doesn't mean you need to use it all. It's about how much of that do you actually need to use in that respect. So thank you for that explanation, Daniela. And just going back a little bit further to the retirement health check case study and the chart that we had up there. Jason, there was just a question, and it may just need a little bit more further clarification or explanation around it. It just said, what does it mean when the income drops below the expenditure line? I think someone's just confusing the bars and the shadowed.
It is a little bit confusing. So I'll just sort of try to draw. If you look at the orange line here, we're looking towards this side here. Okay, so that's your expenditure. And again, this level of income is while they're working, and then we're more focusing here on the modest income in retirement, okay, which will also then move over to that sort of 52-odd thousand that Daniela spoke about earlier. Now, the income isn't ever under here, so it's being fully serviced or met throughout this period of time through their wages, and then it's being fully serviced or met through their age pension and super entitlements here. Where we can see from age 67, it's a little bit above the orange expense line. What that's basically due to is there's a minimum amount that you have to take from your retirement fund when you're retiring. It's based on your age, and at this point, it's 5%, okay, and 5% of your balance. So basically, that minimum amount plus the Centrelink is more or higher than the income or the modest income that this member required. So again, that's what I sort of said. It's a good situation to be in, that they're generating more income than they potentially need in that modest lifestyle, can potentially spend a little bit more. So yeah, it's fully being, their income needs or expense needs are fully being met through their wages and then their super and age pension in retirement.
All right, thank you very much. And just one last question that's come in, and I'll answer this one. Can funds from the sale of an investment property be placed into your super? Yes, they can. You got the non-concessional contribution, the after tax, the cap of 130, or you can trigger the bring forward rule, which will allow you to contribute up to 390,000. Just keep in mind, if you trigger that bring forward rule, it's going to restrict or not allow you to put any more after-tax contributions in for the next 2 financial years. You potentially could contribute some of those funds in and claim them as a tax deduction to offset them against the capital gains tax. But remember, that's called a before tax contribution or a concessional contribution. It's going to get taxed at 15%. Plus also there's a cap of $32,500, and that takes into consideration what your employer's been contributing, and also if you've been making any salary sacrifice. So there may not necessarily be so much room in which to make that lump sum contribution and claim it's a tax deduction. The other exemption to that, as we highlighted before, is potentially this carry forward amount. If your superannuation balance is below 500,000 and you haven't been contributing up to that concessional contribution cap in the previous financial years, you may have accumulated an additional amount that you can put in. So in short, in answer, yes, you can contribute the proceeds from an investment property. How you should do that and what's the best way to do that to maximize your situation, that's where financial advice comes into play, and we're happy to do that. And I guess on that note, if there's any questions that we haven't, that you wanted to ask tonight and haven't had an opportunity, or you're just seeking more of a personal consultation on the matter, there'll be a survey that comes out after this webinar tonight. So please put down your question and we're more than happy to make arrangements for somebody at First Super to give you a call back. And if you are in particular after financial advice, then we highly recommend that you just simply note that on the survey form, and someone from this financial advice team will give you a call and make the necessary meeting arrangements in that respect. What I want to do is just conclude by saying thank you very much again for your attendance tonight. We very much appreciated it. We hope that we've given you some information that you can work with and give you some thoughts about how to plan about your retirement. And again, what this is all about, if you don't feel like you're on track, or you just want to simply contribute more or build your superannuation balance up more before you do retire, there are options available to you. There's those contribution options, there's the TTR strategy, and there's also potentially the carry forward strategy that's available to you. There's a lot of information on our website around these contributions and these strategies. There's also short videos called First Talk that go back through these concepts and explain them again to you. And as mentioned by Louise at the beginning, a copy of this webinar will be made available to you following tonight's presentation. But once more, from everyone here at First Super and from the financial advice team, thank you very much for attending and enjoy the rest of your night.